Welcome. Today, we're diving into the fascinating world of public issues and securities markets. Whether you're curious about how companies raise funds, the steps involved in an IPO, or the difference between equity and debt offerings, this video will guide you through it all. We'll break down the processes, key players, and regulatory requirements, making complex concepts easy to understand. By the end, you'll have a clear picture of how public issues work, who's involved, and why they matter for both companies and investors. Let's start our journey by understanding what a public issue is and why companies choose this route to raise capital. When a company issues shares to the public, the allocation of shares is carefully structured. For issues not made through book building, at least 50% of the shares are reserved for retail individual investors. The remaining shares go to other applicants, such as high net worth individuals and institutions, regardless of how many shares they apply for. This ensures a fair distribution and encourages participation from a wide range of investors. The allocation pattern is designed to balance the interests of small investors and larger entities, making the process inclusive and transparent. Before a company can offer shares to the public, several internal approvals are necessary. The board of directors and existing shareholders must approve the decision to issue new shares. This ensures that all stakeholders are on board with the plan to raise capital. Once approvals are in place, the company appoints a lead manager, often called an investment banker or merchant banker, to oversee the entire process. The lead manager coordinates with various parties, ensuring that every step, from compliance to marketing, is handled efficiently. These internal steps lay the foundation for a successful public issue. Lead manager plays a pivotal role in the public issue process. Acting as the main coordinator, the lead manager is responsible for regulatory compliance, appointing other intermediaries, and overseeing the entire operation from start to finish. They work closely with the issuer to decide on issue pricing, appoint registrar and transfer agents, bankers, brokers, and underwriters. Lead manager also ensures that all agreements are in place and that the issue meets all legal and regulatory requirements. Their expertise is crucial for navigating the complexities of a public offering. The public issue process involves a series of well-defined steps. After internal approvals and appointing the lead manager, the company secures in-principle approval from the stock exchange where shares will be listed. The draft prospectus is filed with SEBI, and any required changes are incorporated. The lead manager signs a due diligence certificate, confirming regulatory compliance. Marketing activities, such as advertisements and broker meetings, are conducted to generate investor interest. Application forms and prospectuses are printed and distributed, setting the stage for the public to participate in the offering. Once the issue opens, investors can apply for shares through various channels, including stockbrokers, self-certified syndicate banks, and depository participants. Applications must be supported by the ASBA facility, which blocks the application amount in the investor's bank account until allotment. Retail investors can also use UPI for payments. Collection banks and R&T agents reconcile applications daily, ensuring a smooth process. In book-built offers, bids are collated, and the cutoff price is determined based on demand. This transparent process helps ensure fair pricing and efficient allocation. After the bidding period closes, the basis of allotment is finalized in consultation with the stock exchange. Successful applicants receive shares credited to their demat accounts, while funds are unblocked for those whose applications are rejected. The shares are then listed on the stock exchange, allowing trading to commence. This marks the transition from the primary market to the secondary market, where investors can buy and sell shares freely. Listing brings liquidity and price discovery, benefiting both the company and its investors. Public issue involves several key participants, known as constituents or intermediaries. The lead manager oversees the process, while registrar and transfer agents handle application forms and allotment details. Bankers to the issue manage the collection of funds, and brokers facilitate the collection of application forms and bids. Underwriters step in to subscribe to shares if there's insufficient demand. Each constituent has a specific role, and all must be registered with SEBI. Coordinated efforts ensure the public issue runs smoothly and meets regulatory standards. Registrar and transfer agents, or RTAs, play a crucial role in the public issue process. Before the issue opens, they design application forms and finalize procedures for bidding and collection. During the issue, RTAs collect and report bid information, help identify the cutoff price, and reconcile funds. After the issue, they scrutinize applications, finalize the basis of allotment, and send rejection communications. RTAs ensure statutory compliance and provide essential information to both the issuer and regulators, making them indispensable to the process. Bankers to the issue are responsible for collecting funds from investors. They must have branches in mandatory centers and provide daily updates on collections. Brokers, on the other hand, facilitate the collection of application forms and bids. They ensure that applications are accompanied by authorization to block funds and are paid commissions based on their collections. Together, bankers and brokers form the backbone of the application and fund collection process, ensuring efficiency and transparency throughout the public issue. Underwriters provide a safety net for public issues. They agree to subscribe to any shares that remain unsubscribed by the public, ensuring the company raises the intended capital. Underwriting is mandatory for book-built issues, but discretionary for fixed-price issues. SEBI requires a minimum subscription of 90% of the net public offer, including underwriters' contributions. Stockbrokers and merchant bankers often act as underwriters, and they are compensated with a commission for their commitment. This mechanism instills confidence in both issuers and investors. Prospectus is a vital document for any public issue. It contains all the information an investor needs to make an informed decision, including company details, objectives of the issue, terms, financial statements, and risk factors. The format and content are prescribed by SEBI and the Companies Act. A draft prospectus is filed with SEBI, which may suggest changes before final approval. A prospectus ensures transparency and protects investor interests by disclosing all relevant information. For book-built issues, companies use a red herring prospectus. This document provides information about the issue but may not specify the exact price or number of shares, as these are determined after the bidding process. The red herring prospectus is filed with SEBI before the issue opens, and any observations are incorporated. Once the price is discovered, it's included in the final offer document. This approach allows flexibility and transparency in pricing, ensuring that the final terms reflect market demand. Investors can apply to public issues during a specified period, using forms available with brokers, syndicate members, and collection banks. The NSE and BSE provide online bidding systems, making it easy for investors to participate electronically. The price band is announced at least 2 working days before the issue opens, giving investors time to evaluate and decide their bid price. Applications must be made using the ASBA facility, which blocks funds in the investor's bank account until allotment. This process ensures security and efficiency for all parties involved. SBA, or application supported by blocked amount, is the mandatory payment method for public issues. It allows the investor's bank to block the application amount until shares are allotted, ensuring funds are secure. SEBI has also introduced UPI as a payment mechanism for retail investors applying for amounts up to Rs. 5 locks. Banks and UPI apps send SMS alerts for blocking and unblocking funds, adding an extra layer of transparency and convenience. These mechanisms streamline the payment process and protect investor interests. The basis of allotment determines how many shares each investor receives. If the issue is oversubscribed, shares are allotted proportionately based on the oversubscription ratio. Applications are categorized by investor type, and the ratio is applied to each category. The minimum allotment is the minimum application size disclosed by the issuer. The final basis of allotment is approved by the company's board and published in national newspapers, ensuring transparency and fairness in the distribution of shares. Green shoe option is a mechanism used to stabilize share prices after listing. Companies can allot up to 15% additional shares to the public, with proceeds kept in a separate account. If the share price falls below the issue price, these funds are used to buy shares in the secondary market, supporting the price. This stabilization is managed by an appointed entity, usually the lead manager, and is limited to 30 days post-listing. Green shoe option helps maintain investor confidence during the initial trading period. Once shares are allotted, the company arranges for them to be listed on a stock exchange. Listing requires entering into an agreement with the exchange, paying fees, and agreeing to rules on disclosure and corporate governance. Once listed, shares can be traded freely, providing liquidity and enabling price discovery based on company performance. The market price may be higher or lower than the IPO price, reflecting investor sentiment and market dynamics. Rights issue allows existing shareholders to purchase additional shares in proportion to their current holdings, preventing dilution of their ownership. The company must offer these shares first to existing shareholders before offering them to others. The rights issue follows SEBI regulations, and shareholders can choose to accept, decline, or sell their entitlement. Rights entitlements are credited to demat accounts and can be traded separately on the stock exchange during the issue period. Rights issue process has evolved, with payments now made exclusively through ASBA. Companies can deliver entitlement forms and offer documents via email, making it convenient for investors. Shareholders who do not wish to subscribe can renounce their rights by selling their entitlement on the stock exchange. This flexibility allows investors to make the best decision for their portfolios, while the company raises the necessary capital efficiently. Companies can also raise funds by issuing debt securities, such as debentures, to the public. The process is regulated by the Companies Act and SEBI's non-convertible securities regulations. The company must appoint a lead manager, file a draft offer document, and obtain a credit rating. The offer document is made available for public comments before final submission. Debt securities must be listed on a stock exchange, ensuring transparency and liquidity for investors. Eligible entities can file a shelf prospectus, allowing them to make multiple debt issues under a single document. This approach streamlines the process for frequent issuers, such as financial institutions and NBFCs. Each tranche of the issue requires a separate prospectus, updating any material changes. Shelf prospectuses increase efficiency and reduce paperwork, making it easier for companies to access the debt market as needed. All public debt issues must be listed on a recognized stock exchange. Before listing, the company must obtain an in-principle approval from the exchange and a credit rating from at least one SEBI-registered agency. If multiple ratings are obtained, all must be disclosed. These requirements ensure that investors have access to reliable information about the issuer's creditworthiness and that the securities can be traded easily after issuance. Debenture trustees are appointed to protect the interests of debt investors. They ensure that the assets securing the debentures are adequate and free from encumbrances. The issuer must create a debenture redemption reserve and disclose the security creation process in the offer document. Trustees, usually banks or financial institutions, play a vital role in monitoring compliance and safeguarding investor interests throughout the life of the debenture. Public issue process for debt securities mirrors that of equity shares. Key steps include board and shareholder approvals, filing draft and final offer documents, obtaining credit ratings, and applying for listing and dematerialization. Advertisements are issued to inform the public, and the basis of allotment is decided after the issue closes. If the minimum subscription is not met, funds are unblocked and returned to applicants. This structured process ensures transparency and protects investor interests. Government securities are issued by the Reserve Bank of India on behalf of the government through periodic auctions. Scheduled commercial banks and primary dealers participate via competitive bidding, while other investors, including retail, can participate through non-competitive bidding. Retail investors can now bid in government securities auctions via stock exchanges, making these investments more accessible. The process ensures broad participation and fair allocation of government securities. Private placement is a method where companies offer securities to a select group of investors, such as banks, mutual funds, or financial institutions. This route is faster and involves fewer regulatory requirements compared to public issues. Offers are made to no more than 50 persons, and payments must be made through banking channels. Private placements are not advertised and can be listed on stock exchanges if they meet SEBI requirements. This method is popular for its efficiency and lower costs. Preferential allotment refers to the private placement of shares or convertible securities to select investors, often including promoters. It requires shareholder approval and follows SEBI's pricing formula. Qualified Institutions Placement, QIP, is a special type of private placement for listed companies to raise funds from qualified institutional buyers. QIPs must be approved by shareholders, and a minimum portion is reserved for mutual funds. These mechanisms provide flexibility for companies to raise capital efficiently. To enhance transparency and efficiency, SEBI has mandated electronic book building for large private placements of debt securities. The electronic book provider platform, managed by stock exchanges, allows issuers and participants to register, upload documents, and conduct bidding online. The system calculates the cutoff price or yield, and successful bidders are notified electronically. This digital approach reduces costs, speeds up the process, and ensures fair access for all eligible participants. We've covered the entire landscape of public issues, from equity and debt offerings to rights issues and private placements. Understanding the roles of various intermediaries, regulatory requirements, and the processes involved helps investors make informed decisions and companies raise capital effectively. Whether you're an investor or a company executive, knowing these fundamentals is essential for navigating the securities market. Thanks for joining us on this comprehensive journey through public issues in the securities market.